Altaf Kassam, State Street Global Advisors EMEA Head of Investment Strategy. Altaf, great to have you with me on set here. Really looking forward to this conversation. I want to talk about global equities first, because it's almost like we've seen a reality check in the US session overnight, in Asia today. Are there too many things that have to actually turn out just right for equities, including the trade tensions, in order to build on the best start to the year since 1987?
Yep, so it's been a great start to the year, and you're right, there's been a bit of a reality check. The global trade tensions are the biggest thing that's going to affect markets this year for sure. And you're right, the fact that Trump and Xi Jinping might not meet before the tariff deadline is an issue. But at the same time, we do believe the political will is there for this to be resolved, and resolved in a way that doesn't escalate beyond a US-China spat, which it is at the moment. So we do believe that, yes, that does have to be resolved, but at the same time, we do believe that that's something that's going to happen.
Yes. You're adding to emerging market debt.
Yes.
Is that to do in any way with the trade story, or much more to do with the Fed?
It's much more to do with the Fed. We do believe that the way that the Fed has rode back on its kind of autopilot, if you like, means that the US dollar strength won't be there this year that we've seen in the past, and that is going to be good for emerging market debt. At the same time, especially in the local currency space, we feel like the currencies have been punished a bit too much, and they're due a rebound. So we see a couple of good reasons, and we're also starting to see flows coming back into emerging market debt after what was a pretty tough year last year.
OK, so on the debt side, you're looking at emerging markets, but when you look at equities, do you prefer the US over the rest of the world?
Definitely, yes.
Why is that?
I think for the US, the fiscal stimulus is still seeing its positive effects play out. We do think that earnings, even though they haven't been as strong as, say, they were this time last year, they're still pretty strong, and we're not as disappointed as maybe the market was worried we would be at this time. And we do feel like that even though, you know, CapEx is maybe pulling back, there's still a strong spending story from consumers in the US, and that's going to help lift the market.
Now, just to dig into the details of the market, I've got a chart here that actually shows the Russell 2000 versus the S&P 500 since President Trump was elected. Now, the yellow line, once the white line goes above that, that actually shows the Russell 2000 outperforming. So we're not quite there yet. I've been asking people, therefore, whether small cap stocks are an opportunity here. You're favouring large cap stocks.
Right.
So why would that be?
So, I mean, the Trump bump, or, you know, the fiscal stimulus did seem to favour the more domestically focused, which tends to be the smaller size stocks. But now we feel, again, predicated on a positive outcome to the trade talks, that large caps with more international exposure, with more exposure to the emerging markets, are going to be more favoured going forward.
Yeah, we have heard in some of the earnings reports, though, actually a reference to the stronger dollar being a bit of a headwind, and that would hit a lot of these large cap stocks. Does that concern you at all, or do you not believe in dollar strength for 2019?
We do think that for 2019, the dollar's going to be more range bound, as I said, with the Fed rowing back on its kind of rate hike assumptions. We don't think that you're going to get that move at the short end. And at the long end, we don't feel like there's going to be a lot of selling of the dollar either. It's going to remain a reserve currency, a safe haven currency. So we see the dollar stuck in a range for this year, which means that dollar strength isn't something that US corporates need to worry about as much as they did last year.
Yeah. You're also within fixed income. You're remaining underweight broad G10 government bonds. Now, right now, I'm looking at the 10-year New Zealand yield at a record low. You're looking at the 10-year JGB yield in negative territory, the 10-year Treasury yield falling as well. We're looking at a 265 handle. What's your conviction that we're going to see higher yields, given this dovish tilt we've had from so many central banks globally, and particularly in the G10?
Yeah, I don't think we're going to see materially higher yields. I also don't think there's much room for yields to move lower as well. So, again, we don't feel that bonds are the place to be versus equities, for example. Right,
so that's a relative trade.
It's a relative trade, for example. And at the same time, I think at the very long end, long duration bonds are always going to be in demand. There are always pension funds, insurance companies, so we do keep a position at the long end as well. Yeah,
what about cash?
Cash, we think, you know, yields are definitely picking up, so it's a great place to have dry powder. There was this massive hunt for yield through 2017, 2018. That has abated because cash yields have picked up. So it's not as bad a place to park your money as it was, say, 16, 18 months ago.
Yeah. And for 2019, then, where do you see the outlook for the Fed beyond the first half of the year? Could we see the Fed turn hawkish again if we see a successful resolution to some extent of these trade talks?
Yes, I think what you would need is a successful resolution to the trade talks. The Fed has been very clear. I mean, what they've effectively said is they're much more data dependent, so every release will have to be watched. If the trade talks are resolved successfully, if that leads to a pickup in capex, if consumer confidence remains strong, then I think we could see one more rate hike towards the end of this year.